The next learning objective is to close the revenue accounts, expense accounts, and the withdrawal account. So let's do a little bit of review. So how do revenues affect capital? Remember, revenues are when you sell something, either a service or a product. Well, revenues will increase the business's capital. And how do expenses and draws affect capital? Well, those both decrease capital. But these changes to capital only occur at the end of the accounting period when revenue, expenses, and draws are closed to capital. In other words, during the accounting period, our revenues do not directly affect capital, neither do expenses or draws. They only affect capital directly at the end of the period when we close out those accounts and capital absorbs them, either going up or down, depending on the effect. So the result is the only way to get an updated capital account is to close revenues, expenses, and draws and merge them into capital. So closing the accounts occurs at the end of the period. Closing consists of journalizing and posting the closing entries in order to get the accounts ready for the next period. The closing process zeroes out all the revenues and all the expenses in order to measure each period's net income separately from other periods. So why close? Well, withdrawals, revenues, and expenses only measure data for that one period. For example, your boss asks you for the total revenue for this period. Because the account was closed, which means it was zeroed out at the beginning of the period, you only have to look at the balance of the revenue account to find the answer. If you did not close out revenue, you would have to find each revenue transaction for this period and add them up. That could be thousands of transactions. Closing these accounts updates capital, as you can see on the statement of owner's equity that we did earlier. And in electronic accounting, closing the books also locks the accounting records for the accounting period being closed. This is important so that no one accidentally changes last year's records, which could affect the amount of taxes paid on the net income. So here are the closing entries that we do. We record them at the end of the accounting period, and they're going to zero out the temporary accounts, revenue, expenses, and draws, and move them eventually to capital. So we're going to close revenues, which will increase capital. We're going to close our expenses, which bring capital down. And we'll close out our draws. They also decrease capital. Okay, so let's talk more about temporary and permanent accounts. So temporary accounts are closed at the end of the accounting period. Permanent accounts, like cash, are not closed at the end of the period. So temporary accounts include revenues, expenses, and withdrawals. Everything else are permanent accounts. These are the balance sheet accounts. They include the assets. You obviously are not going to close out your assets and get rid of them. Liabilities are also permanent accounts. It would be nice to zero out our liabilities and say we don't have to pay them, but that's not legal. And our capital is another type of permanent account. So recall that the income statement reports net income for a specific period. For example, a business's net income for 2020 relates exclusively to 2020. For this reason, revenue and expenses are called temporary accounts. The withdrawals account is also temporary and must be closed at the end of the period because it measures the withdrawals only for that one period. All temporary accounts, again, draws, revenues, and expenses, are closed, which means they're zeroed out. By contrast, the permanent accounts, the assets, liabilities, and capital, are not closed at the end of the period because their balances are not used to measure income. Another way to remember which accounts are permanent is to recall that all accounts on the balance sheet are permanent accounts because they are part of the accounting equation. Of course, the accounting equation is assets equals liabilities plus capital. So temporary accounts would start the next period with a zero balance because they've been closed. And the permanent accounts, their ending balance carries forward to the next period. So let's talk about the cash account, for example. So the cash account on December 31st, at the end of business, has a balance. Let's say it's $1,000. That means that $1,000 balance would be the beginning balance for the next year on January 1st. So these closing entries will transfer the temporary accounts to capital. You can think of the capital account absorbing net income, which is revenue minus expense, and absorbing draws. And capital will go up or down accordingly. Now, to do this closing process, we need a new account called income summary. It's only used in the closing process. And like its name suggests, it summarizes net income. It's just a temporary holding tank, so we only use it during the closing process. And it's going to hold revenues and expenses during the closing process, and then we will close the net income, which is an income summary, into capital. And this will make more sense when we go through it step by step. So let's look at the 4 steps in order. So again, we're simply moving revenue, expenses, and draws to the capital account as shown on the owner's equity, the statement of owner's equity. So here's the steps. REID. So if you ever have to memorize this, some students like to memorize the REID, and you can think of an acronym for that. So what the R stands for is revenue. So what we're doing is we're closing revenues and we're going to put it temporarily into the income summary account. And then we're going to close all the expense accounts and close those temporarily to the income summary account. And once the revenues and expenses are in the income summary account, we're going to close the income summary to capital. Now, at this point, and after step 2, income summary contains revenues on one side and expenses on the other side. And when you have revenues on one side and expenses on the other side, you can subtract the two and you get income. That's why it's called the income summary, because it's summarizing what the company's net income is. So then we're going to close income summary, which now contains net income, to capital. And assuming it's a net income, capital will go up. If it's a net loss, capital would go down. And then finally, we close draws to capital, which will make capital go down. All right, now we're going to do this step by step, and it will make much more sense when you see it in action. So, as always, we learn best when we write things down, so I recommend that you print out this slide and follow through as I step through this. These are our temporary accounts, revenues, expenses, and draws, along with a permanent account, capital, and then our income summary account, which is a temporary account just for closing. We also need a journal page, so please print this out so you can practice doing the journal entries. Okay, now take a look at your ledger. So these T accounts represent the ledger. And this is only part of the ledger, otherwise the company apparently has no cash, no liabilities, etc. So we're only showing the revenues, expenses, draws, capital, and income summary, because that's what is involved in the closing process. So as a reminder, step 1, we're going to close the revenues to income summary. So look up here, and which ones are our revenues? Apparently we only have one revenue, service revenue. So it has a balance of $6,500. Now notice the step 1 says to close it. That means to zero it out. So how would we make this account zero? Well, we got $6,500 on the positive side, so we would have to put $6,500 on the negative side. Now, when you're doing this on a piece of paper, it's really a good idea, if you can, to do the closing entry, now this is a part of the closing entry, this $6,500 debit, it's a good idea to do it in a different color so that it's easy to distinguish the closing entry with the normal balance. So step 1 again says close all revenues to income summary. So we've closed out this service revenue, and notice it says close it to income summary. So we have a debit here. That means we must credit income summary. So now the number 1 is reminding us which step these numbers are coming from. So now we have successfully closed out all our revenues, which happen to be just one account. Now we need to journalize the closing entry. So we need to put this journal entry into the official accounting records, which is the journal. So here's our journal. And so which of these are we going to journalize first? It's always the debit, so that means we're going to journalize service revenue first. And income summary will be the credit. All right, so we're done with step 1 of the closing process. Step 2, close all the expenses to income summary. So we have multiple expenses like all companies do, but we need to close them. So how would we close this salaries expense T account? Well, we got a $1,000 balance on the left side. So to close it out so it has a balance of 0, you need to put 1,000 on the right side. Okay. Now, where do we close expenses to? Our step right here says to close to income summary. So we've got a credit here. So the other part of the transaction needs to be a debit. So we're going to put that on the debit side of income summary. Okay, so we've closed one expense. Now we need to close supplies expense. And this is a credit, so we need to put it on the debit side in income summary. So debits equal credits. Now we need to close out depreciation expense. So to close it out, we need to make it 0. To make it 0, we need to put 1,000 on the minus side. This is a credit, so we need to debit income summary. And again, this number 2 is just reminding us what step number these debits come from. And then to close out utilities expense, we need to credit it. So it now has a balance of 0. And because this is a credit, we need to put the $400 as a debit over here in income summary. All right. So now we get to journalize this. So step 2 again is closing the expenses. So my question is, which are we going to list first? These credits where we closed the expenses, or do we list the debits first? Well, we list the debits first. Now, what a lot of students mistakenly do is they think we're going to debit income summary 4 times. Well, you could, but that's a lot of work. A lot of extra work, and it makes the journal entry pretty large. So instead of debiting it 4 times, we're just going to add these up, 2,900, and we're going to put that as one single debit. So we've added up these debits, they're 2,900. Now we have to close these expenses. So let's start with salaries expense. We have $1,000 as the credit. We've got supplies expense, $500 credit. We got a depreciation expense, $1,000 credit. Now this is why I say it's a good idea to put the closing entries, which are in red, as a different color than what the debit is, because it's easy to grab the wrong number. It's easy to grab this debit and try to debit it instead of crediting it. And so to close utilities expense, we credited that. So now we are done with the second step. We've done the R and we've done the E. We've closed revenues, we've closed expenses. Now it's time to close income summary. So before we can close this, we want to determine its balance. So we draw the line to show that we're doing a mathematical operation. We're just going to sum the numbers above. And when you take 6,500 minus this 2,900, we get a balance of 3,600. Now, what did this 6,500 represent? Revenues or expenses? Well, the 6,500 were revenues. And the other side must be the expenses. So if our revenues were greater than our expenses, the $3,600 must represent net income and not net loss. So now we're going to close income summary to capital. So notice income summary has a balance of 3,600 on the right side. So to close it, we need to put a 3,600 on the left side. And where do we close income summary to according to our steps? Well, we need to close it to capital. So we're taking this net income and we're going to make it increase capital. So there's two ways you know that you need to put this $3,600 on the credit side. For one, the closing entry for step 3 is we got a $3,600 debit, so we know we had to have a credit for the other step. And we know also that this $3,600 represented net income because revenues were greater than expenses. And how does net income affect capital? Does it make it go down or does it make it go up? Well, it makes it go up. So that's another reason we knew we had to put it on the plus side. Now we need to journalize this third step. So here's our journal. And which one are we going to do first? The $3,600 debit or the $3,600 credit? Well, we always do the debit first. So that's income summary, debit $3,600. And capital is going up with a $3,600 credit. Then the last step is simply to close the drawing account. So this Josie Smith, WD, the WD stands for withdrawals. So to close this withdrawals, let me back up a step in case I went too fast. Notice the withdrawals has a $1,000 debit balance. So to close it, we need to credit it. So that's my credit. And where do we close draws to? Well, draws affect capital. So we've got a $1,000 credit, so we must debit the capital account. And that makes sense. How do withdrawals affect capital? They make capital go down, so that's why the withdrawals are on the minus side for capital. And then we need to journalize this fourth step. And notice we have to do the debit first, so capital is the debit. And then we credited the withdrawal account. So in summary, your 4 closing entries look like this in the journal. We've closed revenues to income summary. We've closed all of our expenses to income summary. And then step 3 is we close income summary to the capital. And then the fourth step is we've closed the drawing account to capital. So this process is much easier if you do the T accounts and you physically draw out the steps on your T account sheet. And then notice what we're looking at here is a statement of owner's equity. So the statement of owner's equity shows that the ending balance of capital at the end of May is $15,800. So when we go through the closing process and journalize those journal entries, and then we post to the ledger, the capital's account, the ending balance, $15,800, should match the ending balance on the statement of owner's equity. And that's how we do the closing process.